Hello everyone, welcome to our weekly Think Tank. My name is Carl Kapalunga. I'm the market analyst over here at ThinkMarkets Australia, and it is a pleasure to be with you as we delve into all the key moves on markets for last week and then look ahead to next week. Let's kick off with a look at the cryptocurrency markets and see of red there, except for Dogecoin. Now that's more to do with Elon Musk toing and froing at Twitter and Tesla rather than anything meaningful long-term for Doge, but it got a little bit of a bid side there, up 1.4%. The rest of them, not great, majors there, Bitcoin down 2%, Ethereum down 3.6%, but the broader market was terrible. And I used this term crypto winter in one of my media spots last week. I scanned through the top 100 cryptocurrencies and I could barely find a single chart in a short-term uptrend, let alone a long-term downtrend. Bitcoin chart on screen. We took out that 37,692 level last week. It's a slow grind down on the trend. Short-term trend well established to the downside. Long-term trend is down. We are failing to trade meaningfully above that level, and the trend is well established to the downside. 37 handle now becomes important. Beneath that, 34,329 and 32,992 potentially beckon. Nothing really in the price action or the candles to suggest we won't get there. Maybe one saving grace is the fact that we are at extreme fear on the fear and greed index, and we tend to find that Bitcoin's best rallies come from these extreme fear readings, and its worst declines tend to come from when we're at extreme greed. How about that? Part of the problem mainly for Bitcoin, Ethereum, and the rest of the cryptocurrency market is this lack of traction in terms of real-world financial services, DeFi, hitting a lot of these platforms. And it just appears that what we're getting a lot of now are basically apes in sailors hats and this unhappy chap here. So mainly about silly NFTs, in my opinion, and less about solving some of the world's financial services problems. Ethereum on screen, that's just my opinion. I'm sure you'll have a different opinion about that as well, and the value of your apes and sailors hats. 24.45, the next key level to the downside, 2300, 2163 from there. An encouraging candle in the last 24 hours, that white candle pretty much taking out the previous candle's poor performance, but I think the trend is still your friend here. Short-term trends down. Long-term trend, I think, is now really swinging to the downside, and it's going to just be a case of waiting patiently for a demand-side signal, and that would be some large white candles or candles with lower shadows in and around any of these key levels. Love to see a spike on volume, which would indicate a spike of interest accompanying that move. Until then, I can't see any major reason to be invested at this stage. Having a look at the broader crypto market, we talked about that before, this potential of crypto winter, certainly as we break through 600 billion in market cap outside of Ethereum and Bitcoin, that is a real possibility. Bringing it back home to Australian equities, we can see pretty poor performance for the week here, also down 2%, wiping out much of this month's gains. Worst performance, start with those first. Gold down 7.4%. The gold price having a pretty topsy-turvy week, but ending lower net. Some of the steam coming out of that sector, as it was also coming out of materials. When markets go risk-off, material stocks tend to suffer. Energy also suffering, down 3.5%. Financials 2.3%. The best performing sectors were the defensives. Stocks like utilities, telecoms, and healthcare doing well, and that is a bit of a sign of the times when markets tend to favour those defensive sectors. Having a look at the candles for the week, quite interesting. We see huge falls there, sharp falls Monday, Tuesday, Wednesday, and then a nice bounce back there on Thursday and Friday to close out the month of April. And coming up later in the presentation, I've got some stats for you on how the Aussie market tends to do in May. The volatility index is on screen. We can see a general trend higher here, quite disturbing actually, after what was very well established downtrend post the initial stages of the COVID pandemic. In Asia, weaker performances there in the NASDAQ and the Shanghai Composite, a little bit of a bounce there on the Shanghai, but those markets all set to the downside for April. In the US, the Dow Jones, S&P 500 and NASDAQ were all lower again. The falls concentrated in those technology stocks there. NASDAQ down almost 4%. That's a huge fall for the week. But if you look at the month, 13.3%, I can't remember the last time we saw such a huge fall in a month when there wasn't, a significant crisis around. And by that I mean, a global pandemic or a Lehman Brothers collapse. And I know there's lots of things bubbling under the surface at the moment, but I would say they are bubbling and not exploding on us in terms of risk off. And the S&P 500, that is an extraordinary move to the downside in a single month there, down 8.8%. Just quickly on that NASDAQ move, much of it occurred on Friday, and much of Friday's move occurred because of this one here, Amazon, which obviously has a huge weighting in the index, down about 14% on the back of earnings news there. And if we look at the after hours action, down another 7%. So we could see the NASDAQ start tonight's session on a weaker footing as well. Having a quick look now at the S&P 500 chart, I must admit I was sold a little bit of a dummy here with this rally on Thursday. You can see that nice white candle, lower shadow there, causing a little trough here in an area where we've had demand come in the past. Friday has completely wiped out that demand, and really I think any chance of a short-term rally, that short-term trend is well established to the downside. And we can see the long-term trend now is turning for the benchmark US index. 41.14 is the only key static support level standing in the way, and there is a big gap down to the next level from February last year at 36.94. Very few redeeming factors here in terms of price action and candles, and I can't see how bulls are going to engineer a rally from here. Very disturbing, as is the chart of the NASDAQ, which is far more progressed in its short-term downtrend and its turn to a long-term downtrend, which I think for all intents and purposes is now 100% in place. 12.555 went during the week, 12.397 went on Friday. There's a little level here, I can't remember what it is to be honest, it's just off screen, but again there's not much underneath that. So some pretty poor leads for us from those US markets, and the nervousness in equities markets certainly spilled over into these markets here, which are the industrial metals markets, and this I guess is a proxy for global growth going forward. Aluminium down 6%, tin down 5%, zinc down nearly 9%, copper, Dr. Copper, which again is that key canary in the mine shaft for global growth, down about 4.7%, iron ore down 4.5%. You can see most of the declines in the iron ore price happened early in the week, and to be fair, we did see rallies from there. But I'm concerned by the fact that we are moving out of this demand side market for iron ore into a more of an equilibrium market, and whilst we could move one way or the other out of this consolidation phase, we are edging towards the bottom end of that zone. So certainly a chart we need to keep an eye on going forward. Copper chart on screen, we can see the decline during the week, but holding that key long-term support zone. So going to give that one the benefit of the doubt for now, as I will on nickel. Probably no surprise, we're going to see a little bit of mean reversion back to the long-term trend after this huge rally post Russia's invasion of Ukraine. Looking at the gold price, as we said, it was a disappointing week for the gold bugs, especially considering that gold tends to do better when there's plenty of nervousness around there. We just didn't see that. You can see Friday's candle, it indicating that yes, the gold bugs got off to a great start, but then got hammered pretty much in line with the rest of those risk-on markets. So, where does that leave gold right now? Well, it leaves it pretty much sideways in a sideways trend. Yes, there is a bit of a long-term uptrend here, but it is a fairly weak one at that. So you can see why some of that momentum came out of our local gold stocks. Having a look at the energy markets now, well, West Texas crude oil managed a 2% gain. Brent was largely flat, and we can see we're largely flat here overall on that short-term trend for West Texas crude oil. Once again, these consolidation zones can lead to a break either way. Unlike the iron ore chart, this one's probably looking more to a break to the upside. You can see it's sort of trending towards the last peak there at 109.20. Close above that would give me confidence that we're moving back into a new short-term uptrend for the oil price. That wouldn't be great, of course, for inflation and markets more generally. A break below 92.93 would be good for markets and would indicate that really we're in a mean reversion phase back to this long-term trend and pre-invasion prices. Aussie dollar down 2.4%, but that wasn't unusual for the currency majors as the US dollar rallied. That indicates, again, this sort of risk aversion in markets. We saw bonds getting sold off as well, which is a little unusual because bonds tend to be that flight to safety asset as well. But when you've got stocks going down and bonds going down as well. It tells you that investors are moving to cash because of the inverse relationship between bond prices and yields. When bond prices go down, yields go up. Australian yields up 13 basis points for the week. We'll talk about why in a second. And US yields on the rise. I think a picture tells 1,000 words here. And if this was a chart of a stock, you would be buying the hell out of that stock. It's not the price of a stock, it's the price of money. And when the price of money goes up, like it is on this chart here, it's not good for consumers, it's not good for corporates, they have debt to service as well. It's not good for governments, which have record levels of debt to service as well. So this is bad for the economy, no doubt about that. And it doesn't look like that trend is going to end anytime soon. So that one is concerning US yields, which I actually thought, based on some of these candles, might be on the verge of a bit of a pullback. No, powering higher again and closing in on that psychological 3% zone. So giving you an indication of some of the dislocations in markets at the moment. And much of that dislocation, certainly for the Australian bond market, caused by this data here, which is the March inflation data or consumer price index, as we call it. And that was up 5.1% on the headline. So prices in the Australian economy rising about 5% over the last 12 months. The most significant increases coming from new dwelling construction. Anybody who's building right now know how that feels, up 5.7%. And automotive fuel. Anybody who's filling up at the Bowser at the moment knows exactly how that feels. What the Reserve Bank tends to do, however, is not panic too much about all this stuff. They use the trimmed mean annual inflation rate, which excludes large price rises and falls. So they take that basket of goods that's in the consumer price index and look at the 70% of that basket which moves the least, and that's what they use for their trimmed mean annual inflation rate. And obviously they exclude the 30% that moves the most, which is kind of this stuff here, isn't it? So if you take out, fuel and construction spending and food largely, the inflation rate comes down to 3.7%, which is the highest since 2009. That's disturbing, but is not that far above the Reserve Bank's average target range of 2 to 3%. Now, this is an average over time. So we can see this fluctuate, or the Reserve Bank can see this fluctuate above 3% for a period as long as the average over time is between that 2 to 3% band. RBA is meeting Tuesday, and no doubt this will be a major topic of conversation when they decide what to do with the cash rate, which is currently at 0.1%. Now, the market is now fully pricing in a 0.15% hike in official rates, and that would take it to 0.25%, which, let's face it, even if we did go to 0.25%, that is an ultra low policy setting. That is an emergency policy setting. So it makes a lot of sense. We've got to get there at some stage, and interest rates can't stay at these levels. They need to get back to more of a quote unquote normal level, probably around the 1.5 to 2% level in the not too distant future. By the way, it's been 15 years since the last election rate hike, so there is some thinking that maybe the RBA might wait till June and after the election before they increase interest rates. I would tip we're going to get a bit of a pop-up this week. Having a look at the key data from the USA last week, we saw the GDP number come out and was minus 1.4%. Now, how did they get that minus 1.4%? Well, we look at how much the US economy grew or shrank in nominal terms, and that's basically stripping out the effects of inflation. And we can see that we saw a 6.5% increase in the size of the US economy, which you would normally say, well, that's fantastic. The US economy is growing, and that is a really fast rate of growth as well, 6.5%. But then we say, well, prices went up 7.8% in the economy. So basically, a lot of that growth, which is largely to do with consumer spending and business spending, was simply due to the fact that things got more expensive. So this real GDP, which is the one we've got over here, strips out that inflationary component. We end up with minus 1.4%. So on that measure, the US economy did shrink. Now, this is an annualized quarterly measure, which again, there's some maths in there I won't go into because it'll take too long to explain, trust me. But that also overstates, I think, the magnitude of the decline there in the US economy. And there were some really good reasons for it. So we obviously saw a spike in COVID cases due to Omicron. They're probably on the right side of that now. We saw a lower investment in inventories by business because some of their higher spending in previous quarters was simply backing out. Government spending, some of those government support programs were being unwound. Defence spending, less. Now, there's no doubt in my mind that we're going to see a big ramp up in defence spending over the next few quarters for obvious reasons. And net exports were a bit of a drag because imports were very high, mainly on consumer items there. And that's actually typically a pretty bullish sign for the economy in terms of consumer spending appetite. But many of these factors are likely to back out in coming quarters. So I don't think there's anything too sinister in those numbers to worry about. I would say it's unlikely the US is heading for a recession at this stage. Well, Goldman Sachs would say only a 35% chance of that occurring. Make of that what you will. Is that a good number or a bad number? And the final piece of the economic data puzzle for the week last week was the US core PCE price index. Now, we talked about the trimmed mean inflation rate being the key measure of inflation for the Australian economy, for the Reserve Bank of Australia. This is what the Federal Reserve over in the US looks at, the closest to gauge inflation. We saw a 0.3% increase in the core rate again, but of course, that strips out those volatile items like food and energy. The annual rate was 5.2%. That was an improvement from last month's 5.3%. So maybe a little bit of an easing in the inflation rate there. The headline, which is what all the journos are going to talk about, was pretty awful. That was 6.6%. Whichever one you look at, the core or the headline, the Fed is going to continue its course of attempting to normalise US interest rates over the next few months. In the face of even that weaker data we saw there on the GDP. On expenditures and incomes, expenditures beat expectations, up 1.1%, and incomes up 0.5%, a little bit better than expected as well. And not on screen, but also worth noting, the last month's figures for both of those were upgraded nicely as well. I mentioned before we'd have a look at these monthly seasonal patterns for the Australian market. That is April. You cannot miss it. In theory, the best month for the local market. Wasn't the case this month, so maybe take some of this data with a pinch of salt. It's not a typical year that we're experiencing at the moment, but we normally say sell in May and go away because May is a weaker month than April. It's not a negative month, however, so maybe we can take some consolation from that. And then June, July, August, not bad either. So with April not really going to the playbook, let's hope that May is not as dour as it usually is, and certainly not sour like it is shaping up to be at the moment. Let's have a quick look now at where the value is in the Australian market. Well, the 1 year forward PE consensus estimate is 15.7, which is pretty much bang on where it was for the 3 years prior to the COVID pandemic, noting it's also well below its COVID peak at 20.1. And historically, rule of thumb sort of stuff here, we would say 20 is what we would consider to be expensive for a particular market, 15 is about fair value, and 10 would be cheap. So we're pretty close to fair value on the ASX. That's encouraging. Cheaper sectors, energy still the cheapest sector, well below its pre-COVID average and way off its post-COVID peak. Material sector also looking cheap, similar sorts of metrics there. I would say property trust, not too bad against their pre-COVID levels, as is utilities at 20.4, actually below pre-COVID levels and well off their peak. And then they kind of fall away from there, maybe healthcare on the right side of things. Information technology, certainly a very interesting sector at a P of 36. It's the most expensive sector in the market still. And whilst it is less than half of its peak since COVID, just to see how much those tech shares have been revalued, it's still way above its 3-year average prior to COVID there at 26.3. Having a look at the technical analysis market breadth, and what we're looking at here is the trends over various periods for the ASX 300. I won't spend too much time on this because at the end of the day, Thursday, Friday, that really nice rally we had sort of sent it higher. And we're going to see a lot of that back out in today's falls, which are already on screen, as you would know, we're down about 1.2, 1.3%. But what we can say is with roughly 50% of stocks in uptrends, it's hardly inspiring, and we are well off where we need to be to say we're in a really healthy, broad-based bull market move in that green zone, which is where the highs were from last year. But at the same time, we are well off the bear market lows here, which is the red line. Having a look at the trends in the Australian market, well, again, these are set on Friday's close. But for what it's worth, the ASX 200 was still holding up on the short-term, long-term trends. Discretionary sector looks pretty terrible still, down there, only going to get worse today. Technology, you can see, still suffering down. Best performing sectors, definitely utilities with up. Staples looking very strong. Another defensive sector. Property trust picked up last week, as did the healthcare sector. Maybe keep an eye on those going forward. Financials and energy just hanging in there as well. Having a look at the week ahead, everything's going to pale in comparison compared to the RBA meeting on Tuesday, but there are a couple of little bits and bobs there. ANZ job ads and retail sales, building approvals coming out later in the week as well. And then on Friday, we'll actually get the monetary policy statement from the meeting on Tuesday. So keep an eye out for those. Pretty big week overseas, or at least in the US, where we're going to get the Federal Reserve meeting to discuss interest rates. That's easily going to be the biggest event on the calendar for next week. But hey, we do have European unemployment, some data out there on the Chinese economy. And then the other big one, no doubt, will be the non-farm payrolls out for the US. Pretty rare to get a Federal Reserve meeting and non-farm payrolls in the same week. So no doubt investors will have to remain on their toes. Hey, if you'd like to catch up with me for an hour and pick my brains on the markets and on your portfolio, you can ask me anything in Ask the Experts. Those sessions happen live on Zoom. You just need to get to that website and make sure you register and then tune in at 1 p.m. Sydney time on Tuesday. A quick reminder that ThinkMarkets has all of the products that you need to trade here on the Australian market with a fantastic flat rate there at $8. Incredible customer service. Yes, you can actually ring up and speak to us when you need to. And of course, our world-class trading app. If you're watching me on YouTube, make sure you hit the subscribe button and the bell icon to get notified of our next video update. And of course, smash that like button to let us know you love what we're doing. Well, that's it for me today. Hopefully you enjoyed our tiptoe through everything markets for the last week and the look to the week ahead. All the best for your investing. Until we catch up again. Bye-bye for now.